Ladies and gentlemen, there is a tsunami coming for the Canadian, the US market, and markets all over the world. And it's not the residential real estate that you're hearing about every day. The biggest problem that we're seeing right now is commercial real estate, and it is in for a reckoning. And all of it comes down to math and the way that we calculate it. I'm going to get into that, but at first, I want to show you what you're hearing about every day, all day, is usually residential real estate over and over and over again. Now, let's take a look at what the residential real estate is doing, you guys. If we take a look at where I am in Toronto, so as you know, I normally put things into three different buckets. Number one, we're going to talk about cities that are over 1 million people, and this is what we're talking about here. So if you're in a city anywhere in the G7 countries, this is what you're seeing on a national scale. So I'm in Toronto. We specialize in selling properties in Toronto. So if you guys have been following me for a while, last year when the war was starting, we had mentioned to people, this is time, you guys, to be thinking about selling your property. We've been saying every month, sell your property, sell it, sell it. Now, you've seen these prices drop from an average price in Toronto of $1.1 million, and it has been falling all this way. Now, it has been falling quite a bit, but this is what's got everybody excited, is the prices have gone up this year quite a bit. I did another video on this earlier in the year, and I said that Silicon Valley Bank has given $50,000 to every single seller in Toronto. And should you be taking your $50,000? I think you should. Now, why did the prices go up here? This is the big question. Why? And why it is actually follows the 5-year bond. Now, I'm writing Canada in here, but regardless of if you're in Canada or not, United States, whatever, look at your 5-year bond for the country that you're in. If you notice, when the rates are very high, the mortgage rates are going to be very high. That's when you want to be thinking about what? Buying a home. When the rates are extremely low, that's when you want to sell your property. Because when the rates fall, your home prices go up. That is the rule that I try and teach all you guys all the time, is that you have 1 year to figure this out. For every 1% that the interest rate changes, your home changes 10%. And so as this has been pummeling people over and over again, we're going through periods where homes are losing $10,000 a week in cities over 1 million people. Now, it's less for you if you're living in a smaller city, but the biggest problem we're facing is office buildings. Let's take a look at this report, because this report, boy, oh boy, does not make me feel good. The summary: the overall national office vacancy rate is 17.7% in Q1, with a slight market softening noted in the downtown and suburban markets. Now, this is what you have to remember, is when you are buying a home, they're going to go to you and they're going to say, David, how much do you make? How much can you afford? It's based on me, the person, being able to make the money. So when you see that these massive companies, these REITs, BlackRock, are buying $1 billion building, do you think they're going to the one dude and asking him how much he makes on salary? No. What they need to know is, how much does the building make in profit? And those in commercial real estate know that's called net operating income, or NOI. How much money does the building make? And they're going to give you a loan based on how much money the building is making. So if we, again, go back to what we were talking about in residential properties before, we see right here an average of 13% down overall, but that's from a giant slide, right? 13%. But David, you're telling me with this new article here that it's only 17%. Whoa. I'm going to jump into an article. I'm going to show you a little bit of how we do that, because it's going to lose 70, 80% of its value. Now, faced with higher vacancies, increasing fewer projects have commenced construction in recent years. Yeah, well, hello. If they're losing money, yeah, nobody wants to be starting new construction. Bifurcation of the office space to continue. Older downtown products with outdated amenities have struggled to attract and retain tenants. Of course that is, you guys. And if you guys want, I did a video on that, on repurposing office buildings into residential buildings. And there's one in Toronto that's pretty famous that they're doing right now. We'll put the link up above for you to take a look at that afterwards. Okay, so these rental rates have held stable across product types nationally on a 3-year basis. Right here, this is a big problem, what it's saying in this. So why would that be a problem? Guys, they've printed 50% of the currency in existence was printed in the last couple of years. So we know the price of everything at the grocery store has gone up, the cost of gas has gone up, the cost of rent has to go up to keep up with this because all of the other expenses, rent, their mortgages have gone up, your interest rates have gone up, your insurance has gone up, your repairmen have gone up, everything has gone up. So rents should be going up. There seem to be bragging about the fact that it's stable. I think that's an insult. All right, let's look at this. Figure 2, national vacancy by segment. And so we're looking at downtown class A and B and suburban A and B. And if you just look over since last year, since they started raising those rates, it's gone up, 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 up. So between suburban A and B and central in downtown A and B, it's anywhere from 15% up to 22% vacancy. Now, this is the national rates. You and I know that the rates for buildings in the major cities are much higher than this 22%, much higher. So this goes on to show us these percentages and how they're so high. Downtown is at, they're saying at 18.4%. And I think that that is numbers looking backwards. The numbers that I'm seeing on the ground is much higher than that. So let's look at here, downtown versus suburban vacancy by market. The highest ones in Calgary, 32%. 32% vacancy in the city. Unbelievable. London, 25. Edmonton, 23. Unbelievable drops in these rates. So we're looking at houses going down 13%. The national average is 17, but imagine some of these cities. And here is the problem, is that it's almost impossible to convert these buildings to anything else but parking. What has China done? They're now growing pigs like a farm in some of these towers because when they design office buildings, they're not designed like residential buildings. They're not. Imagine if you had a residential building, you usually have a thin building so that every unit has a window to look outside. But when you have commercial buildings, they build them like in a box, right? Straight up, where you get to the main floor and it's just an ocean of cubicles as far as you can see to the outer windows. You would have to have monster units to be able to have them all fit with code, or else you'd have to have 100 units per floor with no window in it. And they don't have enough elevators in the buildings. They don't have enough plumbing in the building. And so we're seeing deals right now where they can't even pay a developer enough money to convert it. So I don't know what they got to do. Knock it down and build a new one, which seems incredibly wasteful for the cement, but what else are we going to do? So there is an opportunity to build luxury units. But at the end of the day, how many can you build to convert 30% of the city into luxury units? Kind of crazy, right? So it takes a special type of commercial property in order to make it viable actually to do that. But these numbers should be shocking. Now this isn't, I know I'm looking at Canadian numbers here, so you can go to cbre.ca to check that out. But this is the same in the United States, the same thing. What else did I want to show you? Yeah, Toronto here, current quarter net absorption rate. Look at that, minus 2.2 mil. So many bad numbers. Now it says year over year basis, 4 markets have seen sublet spaces decrease, most notably in Alberta. And you guys know that I'm looking at Alberta all the time. If we look at the percentages as it has increased, we can see the downtown market was normally sitting around 6%, which I think is actually high compared to the numbers that I've seen. But look at where it's sitting right now at 17. It's just been climbing with those interest rates over and over again. These are the same numbers that we're seeing, and it's actually very, very frightening. Inventory under construction, very, very predictably, we know is way down, and it's dropped way down because of the overall global market. We're in a lot of trouble when it comes to that. But also, when we look at stuff that is under construction, Toronto, Vancouver, and Montreal are the largest ones with a huge amount of inventory about to hit the market. So when these interest rates started going up, we saw a ton of buildings around Toronto, Montreal, Calgary, all the big cities all around the US. They had to make a decision either to pause building or sell the unit or keep building. Now, not a lot of people actually sold the building. So some were pausing just to see what happens, and some just kept on building. And right now we're going to see a tidal wave of new properties coming available on the market, which is only going to make the problem that is here worse. The work from home thing is here to stay. Now, I want to show you guys a little bit of what I mean about what is the biggest problem that I think is coming for our markets. The problem that we're going to be facing, you guys, is how they do mortgages. All right, so let's take a look at this drawing. Don't make fun of my drawing, okay? Okay, so in this drawing, I have two different ones. I'm going to explain to you what they actually mean. So I have this nice little drawing here of a tower on the left-hand side. For you guys who are in on the podcast, you can go listen to you guys on YouTube. You can go to look at the science of real estate. We have a podcast that goes for that as well. So what we have is a building on the left-hand side, and I write before on it. Now, this is where we're at. Remember what I said, NOI is net operating income. So that means how much profit is the building throwing off after expenses. So it is the total income coming in minus expenses. Say you had a tower that is making $10 million a month in income that's coming in. Before, they were at a 2% mortgage rate. MORT is what I have just written there. 2% mortgage rate. Now, normally, if you have a 2% mortgage rate, you're not going to accept a building that's only making 2%, right? Because you're not going to make any money. You need to have it over. So they call it like a 3 cap, for example. I'm giving you an example. 3 cap stands for capitalization rate. They have to make a little bit more. So how we determine the value of a commercial property is actually the total NOI, which we wrote down as 10 million, divided by the cap rate, 3%. So in this example, if it's throwing off $10 million a month, we would be willing to pay $333 million for this project. So how you would do that is just take 10 million and divide it by 3%. Also, if we go back to before all of the shutdowns happened, the way it was we would get 70% mortgage. This is on even last year, we were having 70% mortgages available. So they would give us a $233 million mortgage on that property. So when they would see $10 million per year NOI, that's the value that they would attribute it to, 333 million. Now, here is the problem. Now, let's just fast forward a few months and see. Overall, a lot of properties are facing some cataclysmic numbers, down 25, 30%. Let's look at the now column now, okay? So in the now column, instead of being 10 million NOI a year, we're now down to like 7 million NOI per year. Big problem. So now the interest rates have gone up so much, especially on commercial, we could see something like this, like a 7% mortgage. So remember that your capitalization rate always has to be higher than your mortgage. That's what they want. So a new buyer of that property would probably be asking for, instead of a 3 cap like last year, they'd be asking for an 8% capitalization rate. So using the math that we did last time, we would say a $7 million valuation divided by 8% is now going to give us our new value of the property. Remember, last year it was worth 333 million. And now in this example, it's down to 87 million. And on top of that, now, if you remember last year, they were willing to give you a 70% mortgage. Now they're only willing to give you a 50% mortgage. So from last year to this year, you went from being allowed to have a $233 million mortgage to now only having a $43 million mortgage. Ay, 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 ay. So imagine these guys now have to come up with $200 million if their loan is maturing, or else they lose the building. Where do you come up with $200 million? Who has $200 million lying around right now? They don't. And this is the problem that a lot of people are going to be facing. Is so when we look at properties, we're looking at individuals and that individual and how much he can pay. When we're looking at commercial properties, we're looking at how much can the building pay. But if all the residents have left, according to the article, and it's true, that's what we're seeing, and if all of the rents are not going up, which is what the article said and is what we're seeing, what's going to happen? Now that their insurance is higher, their cost of maintaining it is higher because of all the inflation. In addition, their rate has gone up. Everything has gone up. And then at the same time as this all gone up, their profits have gone down. So you're going to go in a situation here where a building went from, what is our example again? Let's take a look. It went from $333 million all the way down to 87. So they're finished. They're going to get wiped out. And so this is where, I had somebody call me from Ireland and they are talking about what can we do to change these buildings. And you know what? There's one building that's happening in Toronto, but there's also a dozen buildings that are happening in Calgary. As you saw, they said 30% of these buildings are empty. Remember, it was all oil execs that were there. It doesn't make any sense. Remember, I was saying there's no room for you to build so that each unit has exterior windows, which you have to. What are you going to do? So the only way is if you would have like 4 massive units of like 3,000 square foot each. And that's very, very hard for a city to absorb all these units that are all going to have to be sold for $10 million each. There isn't enough people to buy that level. And so that's going to be a problem ongoing. And so now you're going to end up with a building that was worth 330 million. It's now worth 87 million. But anybody who is going to go and revamp the property would have to spend 100 million on it, but it's still going to only be worth 87 at the end. So at this case, you would have to knock a building down, which costs several million, just to start off from a dry patch of land. So you would have to sell it at a loss. You would have to pay people. So let's take Calgary, for example. Calgary has 12 buildings that they're doing this to. Who's doing it? So who's this intelligent investor is doing it? Well, listen, the city and the province is paying them $140 million as a subsidy to try to do it. They're getting paid to do it. And then on top of it, the city is now going to turn around and subsidize even further to make a lot of these units 60% off for low income housing. So there's always somebody that's going to pay the buck. Now, if that property drops from 333 million down to 87, most people are going to, poof, I don't even care. Has nothing to do with me. But does it? So let me tell you this. The majority of these massive buildings that are worth hundreds of millions of dollars are not owned by one person. They're generally owned by REITs and by pension funds, REITs and pension funds. So you can buy a REIT in the stock market, REIT, Real Estate Investment Trust. You can, their stocks, $20, you can buy them. They all suck them up into these big stocks, and people have been buying them forever because what do they always say? Real estate is rock solid, and even more rock solid than that is commercial real estate. Well, I don't think so. And so this problem is going to continue. So imagine if it's not your problem. Imagine, though, your pension at your company that you've been with for 30 years has been investing into those buildings. It can have knockdown effects. Remember, Milton Friedman always said that when those interest rates go up, it takes a full 3 years for it to hit the market. So I think that it actually hits even shorter now in today's hyper market, like 18 months. But that is from the last interest rate hike. We have only been raising rates for 12 months. So we have not even seen the full effect of the first rate hike, let alone the other 7 rate hikes that have happened in Canada and the other 8 that have happened in the United States. So why is this slow to affect people? It's because a lot of people, especially in commercial debt, have fixed rate loans. The majority of people in Canada, we have fixed rates, but the majority of Canadians aren't taking fixed rates. They haven't been for decades. They generally take variable. And if they do take fixed, our laws, the way they were structured in Canada, generally having us set our mortgages under 5 years. So we're basically all unadjustable anyway. But if you have a 5-year reprieve, a 3-year, 2-year, whatever you've chosen to fix your rate at, that's coming due. And when that comes due, is when you're going to get smacked down. So this is happening right now where we're in a weird situation where we have very high prices still and very high rates still. And I'm just here scratching my head. So all these people who are saying the answer is here, the end is here, I don't believe that. And so the number one argument that I always hear is, David, but Canada, especially more than the United States, Canada is 1/10 the size of the United States, and we bring in just as many people as immigrants. So that would mean that Canada would need to have 10 times the building, right? Proportionately, but we're not doing that. And so they always say, well, there's so many immigrants that are coming here. Unfortunately, if you look at the demographics of the people that are coming here, not all of them have huge amounts of money to buy properties. But even if they did, there isn't enough houses here and we're not building anymore. So you would have to have the houses available, number one. Number two, you'd have to have all the immigrants that are coming in with a lot of money to buy them. And that's not the case. And now the credit is tightening up like a noose around people. They're not lending money. Few people remember this. In 2010, 11, 12, you could own properties in cash, own them in cash, free and clear, have big money in the bank, a credit score of 800, and the bank still told you we're not lending. Because everyone's gotten too used to the fact that if I have a good credit score, I'm going to get a loan. I think you got another thing coming for you. I don't think it is. I think it's a dead cat bounce. But if you think that it's going great, I want to know why, please. I want to hear some good news. I'd love for you to put it below. So it's bad news for people who were overextended on either residential property or if they're in commercial property. Either or, if you're overextended, you're in trouble. If you have been conservative and always made sure that you have money on the side, like I always teach people, if you do that, then you're going to be in good shape. And guess what? You're going to be in an amazing position, amazing to buy some incredible deals as the prices drop even further. So I said a year ago, I thought it was a great time to be selling. Sell, sell, sell all the way down, right? But I'm even more excited right now because there's an opportunity right now where because the amount of mortgages have gone down, that price, remember, we pay 2 mortgages. We have the amount, number one, that the bank, a central bank of the country charges, and then we have the commission that the individual bank wants on top of it. So they have reduced the amount of commission that they want to take, which is what you're seeing in the bond market and the resulting lower mortgage costs. So as the mortgages come down, home prices go up. And this is amazing for people, especially in Canada, where we have a spring market that 50% of the homes sell in the spring market. The rates are down and people think it's a great time again. So, I mean, if you were in the market to sell your property, I mean, it's kind of pretty good zone, I think, right now. But I think there's going to be some amazing deals coming soon. I'm very excited about it. Been preparing for it for 10 years. I recommend that everybody always has a little bit of insurance for themselves. Make sure you get a little bit of gold and silver on the side. You guys, I think it's very, very healthy for you to do that. All right, you guys, I think the next 2 years is going to dictate the next 2 decades of your life. It's going to dictate all of it. Anyway, I want to be helping you along the way. Please come into the channel. If you like this type of stuff, please follow it. If you're thinking of selling your home and you live anywhere in the greater Toronto area, that's what we specialize in. Please go to sellhigher.ca or send me a direct message. I really, really appreciate it. Hope that you have a fantastic day, and we'll talk to you soon.